All right, good morning, everybody. Apologies for the delay. I think you can hear me now. If you can let me know quickly in the chat box if you can hear me, that would be awesome. And then we are going to get started here for the last set the market for 2024. Sounds good? Perfect. All right. Very good. So let me just quickly set a couple more filters and then we're good to go. Again, apologies for the delay. It's always lovely when you encounter technical issues like that last minute. Anyway, good morning. Hope you guys are enjoying your holidays. We've got essentially today and tomorrow left in terms of market activity. I want to go through a couple of things this morning. Um, First of all, I want to talk about the um, oh, hold on. Does this sound good now or not good? Some people are saying it's good, some people are saying it's not good. Still good? No, I think it's good. All right, perfect. All right, let's do it then. Okay, so I wanted to go through a couple of things. First of all, I wanted to go through the potential stagflation environment that we might have in 2025 and what that means from a trading perspective, but also from a portfolio allocation perspective. Number one, I did record a podcast this morning. Hopefully, you guys are getting those podcasts. If everything goes well, it'll be posted either today or tomorrow. I want to get it out as quickly as possible. So we'll talk about that. I want to talk about fund flows quickly this morning. We had a lot of fund outflows on Friday, and um, and then I want to talk about the amount of money markets, fund and money markets. That's actually quite concerning. First, though, let's talk about something right here, right now. I am in this trade with the TST trender. This is our momentum indicator. I am still short right now S&P 500 E-mini futures. This is a 5-minute chart right here, right now. You saw we got a sell signal early this morning. I took it once we broke out of the range 10 minutes later. So I'm short now. I'm still in this trade. I'm short the S&P futures just for those people that care using the TST trender. That's the point. I'm so far the S&P is down since that entry point. Uh, 95 basis points, so 0.9%. That's so far working quite nicely. And just as an FYI, in case you're using the trender, if you're not, please use it. It's seriously awesome. If you don't have it, give us a call. If you need our email address or our phone number, we can put it into the chat box. Just let us know. Okay, but I'm happy to come back to this if anyone has any questions. We're doing a TSD Trender member session, by the way, at 10 o'clock Eastern this morning. So that's in like 50 minutes. We'll be looking at this trade, among other things, there as well, and some things that are taking place. But I want to take a step back and let you know that we are starting to see the potential for a lower high in the equity markets to become higher of a probability thing than it was just a little while ago. So what you're seeing here is just a very simple chart of the equally weighted consumer discretionary ETF. And I can show you the S&P chart. I can show you most other sectors. And most other sectors are starting to now potentially make lower highs. We talked about this the day after the Fed, and we said that it's possible that we will start to see the S&P make lower highs before the end of the year. Now, look, it's the end of the year, couple trading days left in the year, and then of course it's gonna get who knows where in the early part of the year. But I don't want to skip over the potential that we make a lower high. I really don't know. We need to see, we need basically what we need to do is we need to see a break below the Monday, December 23rd lows, or at least below the lows of December 18th in order to confirm that. And then we're gonna measure and map how this looks on individual stocks. If you're using the Market Rover, which is our platform for really following markets and trend following and all that stuff, you will have noticed that there's a lot more stocks that are giving us swing trading sell signals, and I think that's soon going to be followed by different sectors, industry groups, and thematics, themes that are going to start going from that bullish trend to a neutral trend, and then ultimately maybe to a bearish trend. That'll be the next step. Let's first see if these bullish trends hold. So we've been reducing a lot of positions. We got into an equal weighted long position S&P 3 weeks ago, something like that. We closed that last week. Just didn't like the way it was handling anymore. Again, based on that post-Fed reaction, we can always get back in, but right now we're a bit more cautious here based on the things that are happening. We are now seeing the second year in a row where the Santa Claus rally is not seeming to work. Last year, I think the Santa Claus rally didn't work and we were down like 1% or so. This year so far, since the Santa Claus rally was supposed to start, the S&P is down about now down I think about 2%. So sorry about yeah no about there, like about 1.5%. So um, and that is the seasonality I keep talking about. I keep talking about seasonality works in bull markets, but it's a useless, complete trash to use in markets that are not completely linear bull markets. You have to be mindful of that. I'm talking about stocks now, right? And a lot of people just don't want to hear that because it's a convenient, simple analysis tool. But really, all you're doing is hoping that the stock market goes up again after a 10% correction or 5%, and that's basically what the seasonality has been confirming, right? So I would caution you not to get complacent. Now, what's more concerning though is the fund outflows, and this is kind of backing this whole thing up. So let me share with you two charts that I would encourage everyone to take with you as we go into the new year. The first chart is this one here. This chart here basically shows to us the fund outflows that took place last week. So this is the entire year. So this is 52 weeks worth of bars, or it should be at least, or thereabouts, or maybe 50, whatever. And you can see that the prior week, so the week before last, we actually had net 14 billion of inflows, and last week we had 35 billion of outflows. The negatives are over here on the left. So that's a lot of movement. Now, of course, some of this can be attributed to year-end stuff, right? People doing stuff, but I've been trying to get on the phone with everyone I can. I'm actually going to go in a few hours. I'm actually going to drive up to the mountains and I'm going to go spend the rest of the year, New Year's, with one of my hedge fund colleagues, and we are going to ski and snowboard, and we're going to talk a lot about markets, and we're going to spend a lot of time with other fund managers that are going to be up there as well, and we're going to talk about this. But we've already had our dorky pre-Christmas meeting about this, and we were saying, listen, the way the markets reacted after the Fed is concerning, right? Now, again, all the year-end stuff is there, but what's likely going to happen is, I think, as we enter the year of the trader, which is 2025 in my view, we're going to see a lot of people that have been doing this blindly buying the dip strategy, selling volatility, selling puts, are probably going to get wiped out this coming year, not because the market crashes, that's not our call, but because we're going to have a stagflationary environment, where the market's going to get somewhat more volatile, and those big winners, the 2, 3, 4, 5 stocks that everyone's been basically buying on those dips, are probably not going to work as well anymore. Notice I'm not talking about crashes. And so these outflows that you're looking at here on the chart, to me, are a reflection of some of this stuff happening. I was in the office on Friday and I was the only one in the building, but I was not the only one looking at markets. There were a lot of people that are actually constantly on their phone. In fact, I was snowboarding yesterday, and I don't, and you keep bumping into people, and I don't remember as many people looking at the markets in a long time. These are mostly professional fund managers or sort of high net worth people that look at their portfolio, people that actually care about their portfolio. So a lot of people making a lot of moves here at the end of the year, which I have not seen that in quite some time. So again, I'm not bearish. I just want to be mindful of showing you at least what we're seeing. Now, here's another one. This, and I don't want to name names, but there's a gentleman on CNBC that comes on seemingly once or twice a day, and I respect his work. I don't want to name his name because it's going to lead to a lot of emails of hate mails or whatever. The gentleman has never seen a market he doesn't like. Fact. However, he's good, right? So it's good analysis. He talks about the amount of money in the sidelines a lot. Um, and he wouldn't be incorrect. He is not incorrect in saying that that money could be deployed in the market. However, I'm just trying to show you how everyone's so complacent and taking those words out of these people's mouths as if they were hard and facts without thinking. You know, look at the amount of money. The amount of money that's on the sidelines is really more money a result of money printing. It's not because people haven't been allocating money. So this is basically money supply going up. And I just don't believe in that money on the sidelines narrative to be something that's going to propel markets higher. Uh, Again, if you know who this gentleman is, I don't want to name his name because I don't want to get into trouble. And again, I respect the guy's work. Just keep in mind he's never seen a market he doesn't like. He keeps constantly pointing to this amount of money that's in money market funds. You can even take this a step further and say, okay, yes, that money could get allocated to the market. However, the fact that people aren't allocating it maybe say, and by the way, these are not mom and pops, right? This is not you and me. These are big institutional investors, very high net worth individuals that are preferring right now to keep their money in short dated funds, money market funds, treasuries, than allocating it to risk assets. So that says something, right? That's the other side of that. There's always two ways of looking at it. So anyway, does anybody have any questions here before we kind of wrap this up? I know we started a bit late, so I want to make sure we we address any questions there might be. Just quickly checking in on that trender trade. I'm still in it. It's still just kind of consolidating here, but if anyone has the trender, I really hope you're using it. We're doing a member session in 40 minutes from now, so make sure you join us there if you're a member. You can email support@thesteadytrader.com if you don't have that link. Other than that, if there's no questions, I will leave it here. I will wish everyone a very happy new year. We will see you guys. I think we're doing one of these on Friday. Let me check if I'm not even sure when we're scheduled to come back after today. Let me see. Yeah, I think we're coming back then next week on the 6th is when our next session is after this one. So if there are no other questions, I hope this was helpful for some insight. Have a wonderful rest of your holidays. We'll see you guys in the new year. That's next week on the 6th. Any questions, let us know. Again, if you don't have the trender yet, please make sure you hit up our team. It's support@thesteadytrader.com, and we'll see you guys in the member session for the trender in 40 minutes at the top of the hour. Again, Happy New Year, and we'll see you guys on the other side in 25.